Welcome everybody to now the 5th webinar in the Ultimate Trading Guides series here. Super excited to dive into market cycles, talk about how to identify them and how to trade them, and really get into some great specifics. And should be a really fantastic one. We've got a lot in store. Stick around until the end. We've got a great kind of walkthrough at the very end, 7 steps to build your own market cycle that you don't want to miss. So with that, let's go ahead and dive right in. I'm really excited for this one. And Rai, I'll hand it over to you.
Awesome. So market cycle mastery, at least 50% of the whole game is a general market, is a quote by William O'Neill. And this is true in the stats as well, right? We'll get into that a little bit later. Three of 4 stocks follow the movement of the market on a general basis, and 37% of a stock's move is based on its industry, and 12% is based on its sector. So all those stats point to something, especially for stage 1 and 2 traders. What it says is we need to pay some sort of attention to the market, its environment, and how can we build something around that, around our framework around those 2 things to make sure that we're all, majority of the time we're on the right side of the market. With stage 1, 2 traders, what you guys will also see is it's a matter of environment. It's a matter of having some sort of repetition in your system that stops you from going long in a bad market and stops you from going short in a good market. So if we could fix those 2 things today, that's kind of the primary objective of this webinar, is if we can fix those 2 things, what it will do is move the stage 1 traders that we have to 2 and the stage 2 traders to 3, because it will fix that very particular problem where you're placing long trades when we're late in the cycle. You're placing short trades when we're late into the short cycle. And how do you kind of mitigate those 2 and kind of bring those 2 things towards some sort of equilibrium, so that you can, instead of seeing a declining equity curve, you see at least you curb those declines. And what we said in the last couple of webinars is it's all about those small losses, curbing your losses so that you can eventually learn how to win in the markets. So the ultimate trading pledge, basically, you will work as hard as you guys, if we see enthusiasm, we see questions, we're more than happy to answer them. We see participation. We see, a lot of, folks on social media these days also tagging us, asking questions, etc. The more we see that, the more we're motivated to continue these. And that's basically what the pledge is if you work as hard as we are, it's a win-win situation. So we'll continue to do these webinars. So agenda today: what is a market cycle, components of a market cycle, how to trade a market cycle, examples of different market cycle systems, and every successful trader you'll see has a market cycle system. They might not call it market cycle, but that's at the gist of it, that's exactly what it is. And then we'll end it off with what Richard said was the 7 steps to creating your own system. So before we get started today, I just want to ask, for the folks that are live right now, how many of you have a market cycle system? It's just a simple yes, no question. So a market cycle system is where you know that you have to increase some sort of exposure when the trend changes, and you have to decrease exposure when the trend changes. Yep. So I see a lot of yes, no's. So the idea today is we'll give you a framework and things that you should focus on so that basically it will improve. If you have one already, it will improve what you're doing. And if you don't have one, you definitely need one, especially since, once we did the survey in our first 2 webinars, most of you guys are stage 1 and 2s. So with that, why are market cycles important? So let's get back to the point of 3 of 4 stocks in the, follow the market. So if 3 of 4 stocks follow the general movement of the market, it's usually a good idea to have a system kind of that's based around the market. Yes, there are traders that say completely, do not look at the markets, do not look at the indexes, do not look at any of that. But those are stage 3 traders, right? Those are people that have gone through the paces of stage 1 and 2 to get to that state where now they know that if the number of setups is high, then they can go long in the markets. That still, at the end of the day, is a market cycle system, right? If they have a process, they see 15 or 20 setups in the market. well, the number of setups is now high, they feel that the market cycle is now in a positive uptrend, right? Whereas if they see a low number of setups in the market, that's when they get cautious or stay on the sidelines and go cash. That's still a market cycle system at the end of the day. You could call it or frame it whatever you want, or you could say, I don't track the indexes. But at the end of the day, it's a cyclical, repetitive system that allows them to increase exposure as they see increased number of setups, or decrease exposure as they see less number of setups. Some people do this through breadth metrics, sentiment metrics, seasonality. We'll get into all of that later on in the presentation. So essentially what a market cycle is it's human psychology and trading, that it's a relationship between those two components. If patterns repeat themselves, and a market that traders traded in 2010, 15, 1999, 2000, they always are relating that type of situation. They're relating that type of situation back to the current state. So if patterns repeat themselves for the most part, and human psychology has remained the same, and on a general basis, that's what the market cycle is trying to capture, right? It captures both the psychological component and the technical aspect of swing trading, position trading, or even day trading. So components of a market cycle, there are 3 different components that we'll kind of get into, and then the 7 different steps to build your own. The 3 different components and how I break it down is, first is you have to have a trend definition or identification system. So there has to be as simple as, it could be, the S&P moves above the 10 MA. I define that as an uptrend, and the S&P moves below the 10 MA. I define that as a downtrend. When S&P chops around the 10 MA, I define that as neutral. That's the very basics of, you have to have some sort of clarity on what your trend is or how you define trend. And as we'll get into in these later slides, you will then refine that definition over a span of time for you to make sure that you have some clarity on when you should increase exposure and when you should decrease or go short or cash. So that's one of the first and most important points. Having clarity on your time frame, what your time frame is, and identifying the trend on your time frame. And that's the second most important part. And if you don't have that written down, definitely have that written down to make sure that it aligns with how you trade. It aligns with your thought process. It aligns you with your aligns you up with your overall system at the end of the day. The second component of a market cycle is we'll get into the cycle count. And what the cycle count does is it captures the repetitive nature of the market with respect to your time frame and your trend identification or definition that you've set forth for yourself. So you'll see patterns where you'll see a cycle of 10 to 20 days to the upside, see a cycle of 10 to 20 days to the downside. And this is always based on your trend definition. And the more cycles, the more market cycles that you trade based on your trend definition, the better you will get at anticipating, seeing patterns, seeing that psychological and technical components come together, right? And build yourself that market cycle system so that you can move from stage 1 to 2 and 2 to 3 as traders. The third component that we have is the journal. So journaling, visualizing, seeing what your market cycle system is doing is probably the most important part for you to identify what the visual component, how your system's working, so you can make those incremental improvements from market cycle to market cycle, or multiple market cycles to the next market cycle. This component allows you to improve your overall system, see patterns visually. And when you see those things visually and you sleep on it, you go back, so you sleep, wake up, your brain is wired in a way to see patterns in the markets. And that's mostly the technical aspect where you can get into what people call, hey, the market is extended. You could define what extended is for you. Hey, the market is now seeing a stress test. What does that mean? You can anticipate what is going to happen instead of interpreting. So there's 2 stages. We'll get into that a little bit later. But as stage 1 and 2 traders, you want to interpret what's going on and then act. Stage 3 traders interpret and anticipate at the same time as to what they see, where the puck is going, basically. They're not sitting here and saying, hey, today this happened. They're saying today this happened and tomorrow I expect this or that to happen, and they're a one step ahead, and that's why they're called stage 3 traders. The last component, you'll see the cyclical and repetitive nature. You'll see a pattern very easily. Doesn't matter what trend identification system you have. And a very good example of that is, Stan Weinstein puts the 30 MA and now defines stage 1, 2, and 3 and 4. Simple, move above the 30 MA, stage 2, uptrend, chop around the 30 MA, stage 3, downward trending 30 MA, stage 4. Again, cyclical, repetitive nature, and that's essentially what stage analysis is at the end of the day, is a market cycle system. So
can I jump in real quick on
yes,
the
go ahead.
anticipation concept? Yeah, the stage 3 traders are anticipating and interpreting in real time, and then they're coming back to what they anticipated and checking how that aligned with what actually happened. And that discrepancy, the difference between their anticipation, the anticipated like pattern or market action versus what actually happened, that gives them information that then they plug back into their system and gives them valuable information that they can use going forward. So it's a constant cycle of anticipate, see what happened, interpret, compare it to what you were expecting to happen, and then you can easily identify those expectation breakers. But you have to build up to that point. You start with interpretation, coming up with clear rules, and then you build up to being able to have that skill.
Awesome. So I think we could pause here a little bit, see if anybody has any questions on at least the components of it. Maybe take a few there, Richard, if we have any. If not, we could continue.
Yeah, let us know if you have any questions in the Q&A. There's a few here. To use the McClellan oscillator, we'll get into some different tools that you can use later on. The McClellan is definitely, I know many different traders who incorporate that into their awareness of the market health and the market phase. So we'll touch on that later on. Can you share an example of a trading journal? Rai will get into that in just a second here, noting the trend and where we are in the count. And we'll get into stress tests as well. So Rai, you teased a lot of words here that people want to know the definition. So I say let's just dive in.
Okay, so let's start with the very basics. So what I've done here is put up a chart of S&P. You could choose any market. Traders say, hey, I'm a growth trader and I only want to benchmark myself versus the Qs. You could definitely do that. This is just for, just to build a simple example of what a market cycle system can look like. So step one is you just pick a market. So I just picked the S&P. You could pick any market that you want. This is international. This is not related to S&P whatsoever. So you pick a market, and let's say we just put an MA on this. I'll let you guys guess what MA this is, but let's just say this orange line is some sort of moving average that I put onto the S&P 500. Now, this is a simple trend line market cycle system where what I can say is when the S&P is above the rising, I gave it away, 21-day moving average, it's a positive cycle. And when the S&P is below this 21-day moving average, it's a negative market cycle. So those two things alone, right? Above, below, and we'll get into the details in the next slides. This is a very simple trend line based market cycle system, right? Now, if we get to the next slide, what we could say is I want trend identification. That's our first component of our market cycle system. Trend identification means when I'm below this moving average, I've colored that red. So that's a negative market cycle according to my definition. And when I'm above the 21-day, it's a positive or a up cycle in my market cycle system. So that's the second component of it, is the trend identification. Now, I've labeled those as this is when the S&P traded below the 21-day for 20 days in a row. So that's a minus 20. That's the second thing that we talked about, the cycle count. This is a minus 20 cycle count, whereas this is a plus 21 day up cycle in the markets. Now, what we've done so far is the very basics, right? We pick a market that aligns with how we want to trade. We've introduced a simple trend identification system based on the 21-day SMA. Then we've kind of labeled and said this is a 20-day negative down cycle, and this is a 21-day positive up cycle. So now we've gone through the first two steps of building our market cycle system. This is step 2, the cycle count. We've added that to the charts. Now, the third is what I think is the most important and what traders tend to get away from is that no system in the markets will be perfect, right? We it looked like, hey, this works very well. We have a minus 20, plus 21. I'm good to go. I will never see chop. And I saw the word chop, which is like kind of very similar to what we have in the existing market, depending on what kind of trend identification system you have. But there will always be systematic chop in your cycle counts, and you have to factor that in into how you want to build your system. There's no such thing as give me a system that will work 100% of the time, has no system chop. If it was that easy, there would be no stage 1, 2 traders in this world. We would all be stage 3, working from home 9 to 5, trading the markets, and there's, the life will be great at that point. But account for system chop, where now at this point you see we're above the MA, we're below the MA, we're above the MA, we're below the MA. So how can we improve our system? How can we improve our market cycle system to kind of account for this chop? That's where other components come in. What are the number of setups that I see? What does, for example, breadth look like? Some people use sentiment. What does sentiment look like in that period? So those additional components that you could attach to your market cycle system will allow you to navigate the system chop. Whereas when it gets easy and we break the MA, it's very obvious. Number of setups is low. What we see in the market is, things are just left and right getting, slaughtered, and we have an easy downtrend. At that point, your market, identification system, your market cycle count will also be negative. And that's the easy part. This is what we want to kind of focus in on. And, how do you add those additional 1 or 2 parameters? Some traders add too much. I used to add too much. I used to use sentiment, put call ratio, NYSI, the Nasdaq McClellan oscillator. I used to have, and then a volatility indicator. So I used to have 4 or 5 additional parameters to my market cycle. That was way too much. Try to focus in on keeping it simple. We'll get into that a little bit later, but in this system chop, this is a reality. It will happen. You have to come to terms with the fact that this will happen for any market cycle system that you build. Even Stan Weinstein's system, when you chop around a stage 3, can turn back into a stage 2 if it goes back into a rising 30-week rising moving average. So I wanted to make sure we point this out. This is not about perfection. It's about building some sort of, boundaries for yourself to define uptrend, downtrend, but keeping in mind that we will have systematic chop. So next, I just put on, there was then a 46-day upcycle. So once the market reclaimed the 21-day, now the 21 day is rising. At this point, we have a 46-day upcycle, which ended when the S&P again broke below the 21-day moving average. So with that, we'll get into a little bit of step 3. So step 3 is about, I guess, any questions on the cycle count before we go on to stage or step 3.
And as people are leaving their questions, please drop a few in here. I'll ask this, Rai. How should people think about the cycle count in real time? How will they know whether it's going to be a clean down cycle versus a clean up cycle versus just chop? What can they do in real time to navigate that?
So the third aspect of it, which is journaling each day of that cycle count, will give you a very clear idea. So it could be, hey, these themes in the markets exist, or we've had a stress test and now we're anticipating that the next move the market's going to make is to the upside, or the market is in an upcycle, but I don't see the number of setups being enough for me to trade, or I don't see maybe a breadth metric that I follow not being high enough, right? So something like John Boyk uses 3 consecutive days in a row of net high lows being positive for him to then have, a positive stance on the market. So that's kind of like a threat, like a like a circuit breaker type of approach. Hey, I need to see this 3 days in a row at the very minimum for me to then justify that, yes, my market cycle isn't, is positive, but then now I anticipate that I'm out of this system, the chopping phase of or being around an MA, or the chopping phase of net high lows flipping back and forth, right? So he uses that as kind of like a parameter for him to get very bullish on the fourth day, for example, of that. Another way is you could just, I big on scanning the market. Once you scan the market, you will get the best feel for what's going on. So if you can identify and you have your focus list, it's hard to contain your focus list to less than 10 stocks. That's a positive, right? That's especially you're early in the cycle. You're early in your market cycle count. You see a whole bunch of setups at the same time, and you line those things up together, then you'll have a net bullish or positive stance on the market as well. So those are a couple of ways. We'll get into those in the later slides as well.
Yeah, and there's a question how to count the cycle count. Basically, what you do is whenever your system, however you define that, starts a down cycle or starts an up cycle, you start counting. The first day down is -1, all that. And then once the upcycle begins, it's the same thing on the flip side. Anything to add about people tracking the counts, right?
Yeah, that's the third step.
Yeah. I'll add before we move on.
Yeah.
Ross is huge, in how he defines cycles. He's always talking about the quantitative element as well as the qualitative element. So the quantitative is your hard and fast rules. This is what signals a new uptrend. This is what signals a new downtrend. But then that qualitative factor is what Rai was more getting into, where in addition to those hard and fast rules, what else about the environment is informing me about, is this a environment that is conducive to my style? Are there a lot of setups? Are setups working? Are they following through? Are breakouts holding? Are pullbacks holding? All of that. Versus the trend system, whether that's based on the QQQ, the SPY, whatever, that could be in an uptrend, but there could be no setups out there. A lot of stuff could be breaking down, turning. So there's always additional elements that you can add to your system. We're starting very simple because that's how you should start. But as you gain experience, journal more, study history, identify what themes are working at different times, you can stack different layers to your market system that will make it more robust and also more effective. But you have to start somewhere, and you basically want to start with a very simple trend system and then build off of that as you gain experience.
Awesome. So let's get into step 3. So keeping a log of your market cycle will help you spot patterns. I've said this a couple of times now. And if we break that down into, what it will allow you to do is when your position size should be the highest, you can anticipate when the market is going to start to, kind of be a little bit stretched, and you anticipate that things are going to pull in, which is what we call a stress test. How multiple stress tests will lead to a trend change in your, in your market cycle. So if you we're 10 days up in a positive market cycle, you can start to expect that we're going to see some sort of pullback. And that's what we can call a stress test, right? We're let's say NVIDIA and a whole bunch of what you can define as leaders have moved up. And now there's going to be some sort of consolidation. And that's what healthy markets do: consolidate or pull back to, let's say, a rising 10-day moving average. Those stress tests, if there's one of them and then the market stabilizes, is good. If you get 3 of them back to back, it's going to break the back of the market, and it's going to likely lead to a trend change from a positive market cycle to a negative market cycle. The third benefit is it will allow you to reduce your position sizes late in the market cycle. So if we're in a 46-day uptrend and your position sizing is exactly the same as it was early in the market trend, in a positive market cycle, it's going to hurt you eventually, because as we get later on into the market cycle, if your position sizes continue to remain the same or higher, the way the math works is when the market has that pullback or changes from that positive trend to negative, you're going to get hurt equally as much as you were, benefiting from the market when the market cycle started. So as we get later on into a market cycle, you want to reduce your position size, because then the chances of failure or trend reverting back to a negative one is higher and higher. And you want to reflect that in your position size so that when you're hurt later on in the market cycle, like I say, there are no good trades in the market. All of them feel bad when you sell out of them, even if you're up 30, 40, 50%, because you give back that last, 5 to 10% off the top, right? So they will allow you to reduce your position size. You'll learn about the market environment a lot more. So you'll naturally, as you journal, build these mechanisms of, hey, I want at least 2 days of my market cycle to be positive for me to start getting very aggressive in the markets, right? So you learn about the market environment. The more cyclical you get or repetitive you get by tracking and journaling your market cycle. You keep a historical diary of the themes. I think that's what this one's most important. So I have a full log of at least 3.5, 4 years, maybe even more somewhere else. And I moved more digital. It used to be a little bit more handwriting and all of that stuff in a notebook, but it will give you, hey, you could go back in time and say this state of the market reminds me of some very similar state that I was in a couple of years ago. And that is powerful. Like that type of information to be in your head and readily available for your market cycle system is a very powerful component where you could keep kind of a journal of what was going on back in time and how you could relate that to the current market. It also boosts your mental game. You will feel more prepared. You will trust. You'll build that trust with your own market cycle system, and that when your mental game gets the boost, your confidence goes up, and naturally your decision making will be very, very good because you're not self-doubting yourself. You're just trusting what you've built in terms of the market cycle system you have, and you're repeating that over and over. And trust, confidence, and this, your mental game being very high or optimal is a huge thing in terms of performance in the markets that stage 3 traders exhibit, right? Stage 3 traders are focused on performance, whereas stage 1 and 2 traders need to focus on process a lot more. And that's why we're focusing on the process of market cycle. And we'll get into performance in later webinars. So what do we need to track? So all of that stuff, just boiling that down into, very simple. If you don't have a market cycle system, you could just start very simple, pull up a Google sheet, Excel sheet, no excuses, could be a notebook, right? On your desk, just a piece of paper, and you just track, have a trend identification system, start your cycle count, and start tracking some metrics that you see. So what I tend to track is when stress tests are happening in an uptrend. When I see multiple stress tests come together, I get a little bit cautious because that should not be happening in solid uptrends. In downtrends, you want to track the opposite, which is short covering rallies. You want to track themes that are developing in the market, and we'll get into a real market cycle example, the negative 60-day market cycle that we experienced in 2022. And then you want to write the repetitive or cyclical nature of the markets. Hey, people say, the Fed is reporting, and they tend to say there's always a shakeout, right? There's always something happening around Fed days. You could build that right into your market cycle system, right? And you could say, is this something based on my trend identification and my cycle count? Am I seeing this behavior in the markets again and again? If so, then you could improve your market cycle system just based on that observation that you make from one cycle to the next, or over let's say a span of 10 or 15 cycles, and then you improve your system gradually. So I guess we'll cover stress tests first. So stress tests, just to answer that question, is they happen right around day 7 to 10. It could also be that if you're very short term, where you have an identification system based on 10 SMA, it could be closer to 5 to 6, day 5, 6. If it's a 21 day, day 7 to 10 makes a lot of sense. But this doesn't really matter how you define, this really matters on your trend identification system that you have in your market cycle, right? The 7 to 10 days, I don't want anybody to take like kind of hard written in stone type of rule. It's not a hard, it depends. For Stan Weinstein, this is a measure of number of weeks. So if the stock is rising above the 30-week moving average for a couple of weeks, then he would not measure that in number of days. He would measure it in number of weeks. So pressure on the market and the stocks. So let's say you have 7 stocks on your focus list, 5 to 7 stocks on your focus list, and they're all pulling back in the same day, and you are a trend trader, you're experiencing a stress test. Another way you can experience a stress test is when you have 2 to 3 or 4 positions on, and they've been working well, you're making a lot of progress in your portfolio, and you get that one day in the market where that everybody feels, right? Where you're giving back 2 to 3 days of progress in a matter of a couple of hours. That's a stress test. That's what you're experiencing is a stress test. The first stress test in the market, you always have to give it benefit of doubt. But if you start seeing multiple stress tests pile up in an uptrend or a positive cycle count, that's when you have to start getting cautious. That's the third point that Richard wrote down here is closes matter, right? On stress test days, you want to see how much progress you're giving back. And on a closing basis, you'll have better judgment as to what you need to be doing the next day for the most part. And these are very, generalized, things about stress tests and what you will feel on those particular days. And you have to be mentally prepared. And how do you become mentally prepared? You become mentally prepared by journaling. So when you know that you expect some sort of turbulence in the market around day 7 to 10 in your market cycle system, then you will be mentally prepared that you're going to get a pullback. And when you're mentally prepared, you will look into closes matter a lot more. And you will say, okay, I had 5 good days in the market since my system says that it's a positive count. I now expect a pullback. Maybe I'll give back 2 days of gains just to see how things are looking. If you're up, 5 days in a row and you're giving that one day, you're giving back 6 days of progress. Obviously, you want to be cautious at that point. But all this does is, having that market cycle system does is it will keep you mentally prepared for those pullbacks, and you'll act a little bit more mechanically than emotionally as humanly possible.
Yeah, I'll jump in because I
Yeah.
put in a chart of the QQQ here. This is the 21 EMA, this purple line. This is the 2020 market correction bottom where we had the follow through day here on April 6th. This could be the start of your up cycle. And then I think it's about 10 bars later, we experienced this bar here. So think about what's happened. We started an uptrend. We're trending nicely. Things are working. Stocks are breaking out left and right. And then we start to falter a little bit in this area. And then this day is what we call a stress test, where in one day there's a lot of selling happening. But if you're mentally prepared, you're aware of your cost basis. You're ready for this type of event because you recognize, and this is realistic, that stocks just won't just trend up forever. There's going to be moments like this, and if you're prepared and mentally ready for them, you'll be able to treat it much more objectively and keep a hold of your positions. Because what happens after the stress test? We pass the stress test, and the market just continues to trend higher. So think about if you weren't ready for this, and then out of the blue, you see all your stocks down 3%, 5% in a day. You don't want to think emotionally in that sense and say, this market is just going to completely reverse. We're going to go down to bottom. We're going to do all that. You want to, think in terms of cycles, recognize that there will be days like this where there's some intermediate term selling, and treat each of your stocks on its own basis. And if they survive the stress test, great. Let's keep holding the position, see what works. If they eventually hit your line in the sand, that's fine too. But knowing that these stress tests will happen is basically key. So you don't overreact and basically sell your position prematurely when that trend is still in play, and the cycle is just beginning pretty much.
And also one thing, what you may notice is this first down day that we see, maybe some of the stocks are just acting a lot worse than you think at that day. So at that point, you could anticipate, hey, the market's not acting well, my portfolio is not acting well, the stocks that I have on my focus list are not acting well. And when you get this day, yeah, you want to wait, to see how much you're giving back, and then make a decision based on that. In this case, the market just uh, what people call a shakeout, right? Came back in, fill this gap area, next day gap up, and then it's on its way again. So
yeah, the key thing is be prepared and
yeah,
recognize that
yeah,
this can happen, so that you're continuing to follow your system, follow your process, and you're letting the stock work for you, unless instead of stepping in outside of your rules and just doing something because you're frightened or scared or think the world is going to end. Listen to your market cycle rules as well as your position management rules.
awesome. So the second thing that we want to be tracking is themes, right? So we want to track themes. So a theme is basically when an industry group is moving in tandem. So it could be, hey, the semis are moving, or the cyclical stocks are moving, or retail space is moving, or cannabis names are moving. So 37% of a stock's move is dependent on the industry group that it's in. And if it's in a good industry group, for example, NVIDIA, SMCI, all of these names in the semi space that were acting well, they were moving in tandem. Or in the cybersecurity space over the past decade, right? OKTA, Coupa Software, all ZS, Zscaler, all of these type of names that are part of the same industry group. There's a theme behind it. You want to be tracking those themes, because as I get into the real life example from last year, when the 60-day market, cycle ended, negative 60-day market cycle ended, there were three very particular themes that outperformed in that next upcycle that we got. And you want to keep tracking those. This is another form of saying keep track of relative strength. It's really the same thing. So you place the odds in your favor. Stage 1-2 traders don't place the odds in their favor. They'll go pick a name that is a kind of a lone warrior, doesn't relate to any industry movement or a group that could be moving to the upside, and they pick that one stock that's about to not perform with the markets, and because it's not in a good industry group, and then they blame the markets for their failure. So to line up the odds in your favor, you want to have these, pay attention to some of these statistics, so that you're picking stocks when you go from a negative market cycle to a positive market cycle. You're picking things that will move with the market and move because they're part of a good industry group as well. So let's get into kind of a real example. So April 20 last year, we really had there was some systematic chop, and I won't get into like exactly what kind of system. I want you guys to pay a little bit more attention to the concept that we're talking about and how you could implement it for your own trading. So hey, what MA is this? What system is this? Doesn't really matter. Pay attention to what we're trying to accomplish in terms of having some sort of market cycle system. So there was some system chop right around April 20th, but then we began a negative down cycle. So the trend identification system triggers to the downside. That was day -1. So April 21, 2022, day -1 of that day. And then we get into -2, 3, 4. And now around day 5, 6, based on this system, market cycle system, we got a short covering rally. This was expected. So market went down for 5 to 6 days in a row. Now we expect, hey, we're stretched to the downside. We expect some sort of short covering rally because we're in a negative market cycle. We expect some sort of short covering rally. We got that on day 6. Then we continued lower. And then right around day 10 to 12, we got the same thing. We got the second short covering rally. And then I logged the fact that, hey, it was FOMC day. So we closed right up into the highs of that session for that particular day. But then, hey, the market, continued. This was expected behavior in the context of a systematic downtrend that we were in from April 21. We're now into May 4. And now it's 10 days into this negative market cycle. We continue lower, and right around day 17, 18, we see another short covering rally. So in a downtrend, you want to wait for the closes to see how the closes are. Usually in a downtrend, closes are pretty bad, right? Things tend to fade into the close. So May 13, we saw our third short covering rally. May 26, we saw a rally in semis. So the point that I'm basically trying to make here is the fact that you have this daily journal of what you see is going on purpose. If there's nothing to write, some traders will overly, get aggressive. Hey, I saw this. That doesn't help you either. And some trade, what I'm trying to show is you want, I track short covering rallies, I track stress tests, I track when the trend identification system says it's triggered to the downside, and I track themes. I feel those are most important. You have to kind of figure out what's most important for you at the end of the day as to what helps you and what kind of trader. If you're a swing trader, you want to get a little bit granular. If you're a position trader, you want to keep it simple, right? You could have a 10-week line system completely based on that. So don't over journal or over comment, because if you have a comment every single day, it doesn't really help. You're just confusing yourself, right? And introducing too much data to your market cycle counts or your market cycle system. So May 26th, negative 26 day rally in semis. June 20, negative 30, and we got our fifth short covering rally in the context of a downtrend. So we fast forward straight. All of June was very brutal in the markets last year. So straight we go from minus 31 to minus 45. June ends, we don't really see it. July 5, we saw the first signs of a rally in biotech. So now we start to see some group picking up and saying after 51 days in a downward market cycle, we see a rally in biotech. And eventually on day 58, on July 14th, we start to see a few setups emerge. That's a note I made for myself. Hey, I'm scanning the markets. I'm doing my daily routines, which will be the topic of our next webinar, right? And I'm starting to see a few setups. Something different is happening in the markets that hasn't happened over the last 58 sessions in a row, right? So themes in healthcare and biotech. Now watch list review, WR is watch list review, shows 3 themes. Again, they're at something from July 14 to 18 changed. I noted that, kept that in my comments in my journal for my market cycle system. And then surely enough, the trend identification system then triggers to the upside, ending a 60-day down cycle. So I tracked stress tests. I tracked short covering rallies in a downtrend. I saw themes develop, and then I started to see setups on July 14, 2022, which eventually ended the down cycle, triggering a new up cycle in my system, in my microcycle account on July 19. Just doing this alone, what it will do is it will keep you on the right side of the market for whatever time frame you define for yourself. Be it you are a weekly trader, monthly trader, quarterly trader, or daily, swing trade. It does not matter. This thing is going to work as long as you use this same framework. You'll see the same patterns for your, for your market cycle system, and you will operate based on that. And that negates any other opinion in the markets, because your own opinion is usually the most powerful if you've done your homework and kept track of this. I have over 3 years of digital, journaling based on my market cycle system. I have 3+ years in a notebook as well. That gives me the confidence to go out there and position size when things trigger to the upside, go cash and short when things triggered to the downside on April 21. So just having that going back and forth, it will give you so much confidence. Again, boost your mental game. You will see patterns. You'll see this repetitive nature of it. So the formula
before we go on,
yes.
Rai, I think there's some good questions and thoughts here. First, I'll add just tracking the length of cycles, both up cycles and down cycles, is really valuable information. It lets you know, when are we late in the cycle based on how you determine it. And it will also let you know extremely strong versus extremely weak market periods. This was a down cycle that was 60 days, which, right, that's pretty stretched, right? That's getting up
That,
there. So
yeah.
it helps build intuition. Hey, we're getting later in the cycle. I should be less aggressive to the short side, and I should really up my game, trying to look for, the next batch of leaders. Similar to the upside, if we're in an up cycle and we're getting to day 80, day 100, whatever, you're not going to want to be as aggressive as you were early on in the cycle. And you should start think, hey, should I sell some into strength? All of this. So, Ryan, for your system and maybe as an overall framework, how should people think about the count and what's considered early versus late?
Yeah, so it's very easy. This is early in a downtrend, right? At day 1, 2, 3. So if you want to position on the short side or go cash, right? You could use this negative. So that, hey, we're now in a down. I want to track my position trades. Okay, my position trades are now giving up 3 to 4% of the day. Now they're down 7 to 9% a day. Now they're down 8 to 10% a day. Hey, at some point you want to build that threshold to say, okay, enough's enough. I think we're heading into a bigger cycle, or my portfolio is saying that we're about to head into a bigger cycle, and you want to sidestep that. So that's one way. The other way is if you're early, in a positive market cycle, you'll see, and we'll cover this in slides coming up, but early in a market cycle, what will happen is two things. Breadth expansion, right? A lot of stocks will move up to the, as pressure is released and trend changes, breadth increases. Why do people track stocks above 40 MA for as an oversold setup? Or why do people have the Nasdaq McClellan oscillator, right? And they track that. That's breadth expansion happening all at once early in a market cycle, right? During these 60 days that we had, why did people say 2022 was terrible? We had a 60-day, which is April, May, June, and July, 4-month down cycle in the markets. It was absolutely brutal. We saw 1-day rallies in the middle, and things were sold into the very next day. So that's why 2022 was brutal. You could visualize that with a 60-day downward trending market cycle. So I don't know if I answered your question. I'm pretty sure I did some of it though.
Yeah,
Right?
yeah. And there was a really good question from Michael. Hey, Michael, how's it going? Um, Thoughts on how to keep our journal simple. I tend to write each day and have confused myself in the past. So I think that's something really good to talk about. And I think we'll even expand on journaling and all that in a future webinar. But just in
So
the
I'll
context of
go
market
back.
cycles. Yeah, go ahead.
So I track these 4 things to keep it simple, right? I don't want to I don't want to, journal, hey, today mortgage rates were going high. That has nothing to do with your system. Or today the market moved because a Fed speaker was saying this. Sure, that could be valuable information if that's a key metric for your trading, right? If you trade based on news and macro, it's a very key feature. If you don't trade based on news and macro, it's not a key feature. So you want to maintain very definitive data points that will help you make decisions. These 4 data points, and that's what I try to demonstrate over here. That's all I'm keeping track of, right? Keeping track of themes, keeping track of short covering rallies, and keeping track of stress tests. And I did that throughout. And then, as day 58 rolled around, I started to see a few setups. That's what I'm trying to show. There's nothing to document here for me on these other days. So I keep it simple. I keep the data points that I feel will help me in my decision making and track those only. There's no point, day 31, the market opened down and stayed down. Like there's no point in doing that. It doesn't really help you, right, make a decision. So you want to have very, that's what I tried to show here. Very definitive, 4 points that I track, and you could define those for yourself as well.
Yeah, and then one more question before we move on. There's a lot of questions of how do you know it's an SCR? How do you know it's a stress test? Maybe take a step back and and talk a little bit
Yeah.
about that. Obviously,
So,
we don't know it's caused by short covering, but it's just in the context of a
so,
down cycle, large up. Yeah, go ahead.
so stress test. Let's talk about stress test. What is a stress test? It could be I have 4 or 5 positions in my portfolio, and I experience a day in the markets where I'm giving back 2 to 3 days of progress. That's a stress test, right? You made progress. Now the market's saying, okay, I'm market just plays on your emotions at the end of the day, right? And your emotions can lead to bad decision making or mechanical plus emotional good decision making. So market comes back, then you go in, interpret, okay, I just experienced a stress test. Is this the first one in the uptrend? Okay, that's fine. I'll give it the benefit of doubt, prepare accordingly. Is this the third one? I was now up, let's say I'm up 4 to 5 days in a row. And that first stress test, I gave back 5 days of gains. That's not good, right? That's the market telling you that's not good. Step aside. You need to reevaluate what you're doing. So that's what a stress, that's one way to gauge a stress test is to look at your portfolio, look at your holdings, see what they're doing and what feedback they're giving you. That one day when the market we've all experienced this, where the market, pulls back in and you give back a whole bunch of days, that's a stress test. The second component is every one of us should maintain a focus list, right? A focus list meaning these are a list of actionable ideas that we need to track. And if your focus list is pulling back in and stocks are giving back gains or pulling back into the 10-day, for example, that's a stress test. So you could log that as a stress test as well. That's a second thing, right? For your checklist when you're looking for stress. So those two combined will give you kind of enough feedback to kind of label a day in the markets as a stress test for your system, right? For your system, not a guy that's tracking news, not a guy that's tracking, earnings, fundamental, etc. From a technical standpoint, if you could define those two things as stress tests. The second question that you had, Richard, was how do we define short covering rallies, right, in a downtrend? How do you define what's the definition for those? A short covering rally is basically as the market has been down for 5 days in a row, you expect some sort of initial rally to come to, because markets don't go, the market didn't go down, 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 down for 60 days in a row, right? Open is here, low is there, open is here, or low is down here. It wasn't like that. So as the market moves down, we'll get periods of, where we see some sort of rally attempt. So these days, it's the same concept as stress test, but we've flipped it around now. We got 5 or more down days, we see some rally. We want to see how that rally acts. If we see short covering rallies for 2 or more days in a row, right, then we could start to anticipate, hey, maybe this is an intermediate short-term bottom in the markets, and we'll see, and our stance will change. What happened in this case was there's a short covering rally sold into for 3 days in a row. Short covering rally sold into for 6 days or 7 days in a row. Short covering rally sold into for 9 days in a row. So we didn't see back-to-back kind of rallies, broad-based themes coming through. That's what told us the fact that it will continue to remain a bigger downtrend because there's a lot of space. April 29, everything got sold into. Anything that rallied on 28 got hit. We're back to the new lows. Got hit. Now we see a rally. Got hit. So I hope that makes sense in terms of how it's the same concept as stress test, but defined for a downtrend or a negative market cycle. Okay, so
one more. Sorry,
yeah.
For your system and how you view the markets, how do you determine when there's a theme that's standing out? What are you looking at? Are you looking at individual stocks, ETFs? How do you determine whether on a particular day there's a group that stands out?
Yeah, we'll get into that in the next webinar because that's all screening routines. How do you determine all of that stuff? But basically, I maintain 3 watch lists and I review my universe and including an ETF list. And it's very easy to say, okay, what worked today? What's happening? What's up? And what's starting to creep up as stringing together consecutive days of relative strength in a row, so that you could call that a theme. So when we say biotech rallies, I see 3 to 4 to 5 bigger biotech names starting the rally, or healthcare names are starting to act well. 3 to 4, 5, setups in the healthcare space. Now you could justify that as a theme as well. It gets very obvious. Like you'll see solar space kind of, especially in 2020, 2021, where the solar space, a whole bunch of solar names all set up kind of at the same time. In 2022, December of 2021, all the energy names set up, all the whole space, energy space set up. The absolute strength score was higher than any other industry group as well. All the energy names look good, and throughout 2022, energy names outperformed, right? So keeping track of it, we'll get into the depths of it. I think it's a better conversation for the next webinar on how to track themes. So I want to get into the formula for success with market cycles. You will not have this perfectly optimal system. There will always be what people call chop and churn in your market cycle system, but you have to build mechanisms for that so that you can handle those chop areas effectively. So you experiment, you fail, then you learn from those failures and improve, and you repeat that, and you keep going in this loop, right? To make sure that you have a system that works for you. There's no perfect checklist. There's no perfect magic wand that we're trying to sell here today. You have to go through multiple market cycles for you to see what's going on. And then you just go into this loop where you experiment, try new things, you see them not working, you check those out, you try to improve your system, and you keep going in this loop until you have something that's optimal. Perfection, I really want to get this across, is it's not going to be perfect, but you have to, if we have a 20-day down cycle followed by a 20-day up cycle, and then we have a 46-day up cycle, and over a span of 80 days, right? 60 days are an up cycle and 20 days are a down cycle. You should be making money in the markets and on those 60-day uptrends, right? At the very least, you should have some progress. That's not, again, it's not a perfect system. It's you identify the broader trend. You have a very clear definition for your trend identification, and you're on the right side of the market at the right time when the market is trending to the upside. So, Richard, if you want to start with trading early in an upcycle.
Sure thing. So, again, these aren't hard and fast rules. They're more guidelines for you guys. So first, trading early in an upcycle. I saw a question earlier, when do I start? Am I anticipating the market cycle? Do I start after it's confirmed? All of that. Basically, I'd say in stages 1 and 2, you don't want to do anticipation. You want to follow your rules, and then whenever they say a cycle has begun, that's when you can start building into positions. Stage 3 traders can look more about how things are shaping up, looking at leaders setting up before a market cycle has begun, and then they can anticipate by those leaders. But again, we want to focus on interpreting in stage 1 and 2, and then we can move to some anticipation in stage 3. So once we've started upcycle based on how you've determined it, you can start taking positions, and we'll talk about position size a little bit later on. Early on, Rai mentioned this, breadth expands. The stocks you put positions on day 1, 2, 3, they should naturally build profits for you, build that cushion in, because when that cycle starts, it's the expectation that things will work. Breadth is expanding, the market is improving, that pressure is getting lifted off. So basically, if you're not seeing that positive feedback, that cycle may fail shortly. So just pay attention to that. And then we'll get into this later, as I mentioned, progressive exposure versus full positions. It depends on your style, what works for you. Rai, I know, goes full positions and even a little bit heavier sometimes early on because he's stage 3. He's built that anticipation. He knows what's going to work and how to manage risk. More earlier on traders might want to start with half positions, and if they see that progress, then still early on in the cycle, they can move to a full position. So again, it depends on where you are in your trading journey. And Rai, I want to hear your thoughts on this last point here, progressive exposure versus full positions early on in an upcycle.
Yeah. So in the last webinar, what we covered was the fact that you should put on, again, we're talking to stage 1 and 2. I think a lot of this comes down to, I see a lot of basically stage 1, 2 traders communicating with stage 3 traders and trying to mimic what they're doing. Stage 3 traders got where they are by following these steps where they put on half positions, quarter positions. Ross says if you have $1 billion portfolio, I don't care, put on 100 shares, see if they work, and then scale up from there, right? So you have to go through that for you to build a feel for the markets. And that feel, it can't be quantified. It's just seat time, experience, different market cycles, many different market cycle counts that you go through, and now you see a cyclical or repetitive pattern in your system, right? So put on stage 1, 2 should not put on full positions. Don't oversize. That's how you blow up quickly and eventually give up, and that's how you fail, right? Stage 1, 2, just put on, when my market cycle count goes positive, I will put on, max number of, let's say, 2 to 3 positions, and the position size will be 1/4 of my full position size. That's a good place to start. The idea of that you will become this, magical trader very, very quickly if you learn 2 to 3 setups and all of that crap. That doesn't happen because psychology takes over, and that first day you see a stress test, you either then you sell out, and then you're later on in that upcycle, then you start buying back at the wrong time, and then now you think the market's against you and all of that stuff. So start small, see how things work early in an upcycle. Even stage 1, 2 traders early in an upcycle, your position size should be the biggest, right? If that biggest doesn't mean full position size, biggest can mean, okay, I used to place a full position size. I'm in stage 1, 2. I realize that I should start with 1/4 of my position size. Start there, and then the next market cycle, if you've built up that enough, if you see it working, now move from 1/4 to a half, right? And then slowly work your way towards that full. All I'm trying to say here is you have to realize where you are in your journey. Do not place full position sizes, oversized, and then in that stress test, you don't know what to do because you don't have the experience or the seat time to kind of tackle that for yourself. So, that's all I had to add. I think I can't emphasize enough oversizing and full position size and macho sizing and all of these things that we see on social media. Those are stage 3 people that have figured it out. You have not. You don't have the right. And that's what we said last webinar too. You have to earn the right to position size, right? So, yep.
Yep, I think that's good. Yeah, and if you want to learn more about progressive exposure, I highly recommend watching this webinar that we did with Anish Sikri. He talks a lot about listening to trade feedback, how to size up, how to size down, all of that. So I'd point you over to this. Just search art of position sizing on YouTube or on our channel. You'll be able to find it, and it's really in depth, and it goes through a lot of example series of trades as we talked about last webinar. So I think we can move on from this point. Trading later in the upcycle. So I would say focus more on less obvious buy points. The leaders, and I learned this from Oliver Kell. This is a really golden nugget. The leaders will be leading the overall market in their cycle. So that means that their price, where they are in the price cycle, whether they're breaking out versus pulling back, all that, they're going to be leading the rest of the market, the rest of stocks. So the stocks that are going to be breaking out from bases later on in a cycle, when you're already day 30, day 40, whatever it is, whatever late is for you, they're going to be more the laggards. The leaders will be basing, setting up pullback entry points, all of that. So you want to be less aggressive late in the cycle and stay focused on the less obvious buy points, because those breakouts are more likely to fail later on. There's less institutional backing behind them. And in addition, you want to overall do less. Let positions work for you. Size less later in a trend, because the risk is elevated, because we're more likely to have, it's more likely for the cycle to end and for the stocks to start breaking down and start a down cycle. What does late mean? We touched on that a little bit. Basically, what you want to do is go back, define your system, and study, what is the average length for an upcycle? What is the average length for a down cycle? what does it look like when a down cycle starts after an extended period of an upcycle. You want to study all of this so you can pick up those clues in real time, and then you can decide for yourself what does late mean. But typically early is first few days, especially of a new upcycle. And then late is when you've already been in that for a few weeks. A lot of the leaders have already made solid moves, and you feel like you're chasing. You're not at prime buy points. And as I mentioned, position size should be progressively lower as the cycle extends. Rai, anything to add on this slide?
Yeah, this one for me it's most important because the way the math works is early in the cycle, you size try to that your size should be the highest. Stage 1 2 traders should not full position size. That's not what we mean. Later on in the cycle, if you do place a position on, and if you're placing the same size as you did early in the cycle, what it will do is when that pullback happens, when the probabilities of a pullback happening are much higher later on in a cycle, you will experience bigger losses because things tend to move faster to the downside. Example of that right now, early September. Look at CELH. People that bought, you want to buy closer to that gap up, right? Where CELH had earnings, rallied from there, and we were fairly late in that upcycle. And then we saw a day where it went from it's basically gone from 200 to 160 in a span of 4 to 7 sessions. Anybody that got caught in that, we were late in that cycle. Two, if you did get caught in that and you think it was a good setup, everything checked off, things look good, perfectly fine. But your position size later on in the cycle should be much reduced so that the damage that you take later on in the cycle relative to the progress that you made early in the cycle, the math works out so that your equity curve continues to rise, right? What you don't want to do is size the same, and now you negate all that progress that you did. You did everything right up to that point, and the market's about to change its trend or go into this pullback mode, but your position sizing hasn't reflected the fact that you've rallied quite a bit. It should be a lot less so that when the pullback happens, you give back a little bit, not everything all at once, right? So next is trading early in a down cycle. You want to cut your weakest positions immediately. Something that I've heard Mike Webster say is you take your portfolio and you rate your positions from the strongest to the weakest. You want to when your market cycle count goes negative and your market cycle system says we're on pause, the trend is on pause and we're about to go into a negative trend, you want to cut your weakest positions, not hold on to them and hope that a positive market cycle will come, right? If you're short, again, you don't want to short with a full position and 35% position short and all of that stuff. As stage 2 traders, put on some test trades if you are shorting or if you want to build that skill, right? Treat trending positions on their own merit. So for example, you have ELF from 4 gap ups ago, right? And you've traded 4 earnings cycles of ELF. You have enough cushion. Revert back to your bigger system for those positions. If you're up 50% or more, 60% or more on these positions, you should be looking at the weekly chart a lot more, not you don't want to use a swing trading system for your position trades, and you don't want to use and vice versa, right? So treat your position trades that are up a lot more on their own merit, because the market cycle may have a negative cycle for maybe 5 to 7 days and then go back up. So you want to treat those good positions that you have accordingly, maybe based on weekly charts. This one we covered, look for short covering rallies around day 5, 6, and 10, 12. Again, this is very dependent on how you identify a positive and negative trend. These are not set in stone numbers. So what I found good for my system was day 5, 6, and day 10, 12. I usually tend to see short covering rallies when in a down cycle. For your market cycle, it will be different. It could be, maybe you see it day 3, 4. And day 17, 18. But as you go through and journal many different cycles, you'll notice that pattern for your market cycle system. So trading late in a down cycle. So sell short positions into strength. So basically, as we move down and you're anticipating a short covering rally in a down cycle, you could start to anticipate and sell your short positions to maximize your gains. Always, always, you're monitoring for relative strength, building your RS list, and looking for themes. Those are the very basics of what we've spoken about from webinar 1 to 5 or 1 to 4, right? So keeping track of relative strength, that's an edge that we have in the markets. You want to build your list, be in tune with the markets, and themes. That's something we could track through the market cycle count journal, where we see a theme in healthcare, we see a theme in biotech, we see a theme in semis, right? This goes back to 37% of the stocks. Our stocks move is related to its industry group. 3 of the 4 stocks move with the market. So you want to be ready when that trend flips from down cycle back to an up cycle. Look for stocks leading the market cycle. So that kind of plays both on the downside and upside. Most important here is stocks that tend to go up, like we saw, Square, PayPal, Roku, and all of those. They led the up cycle. They also led the down cycle. That's just the nature of the market. So you want to be in tune with that. Watch for potential up cycles, right? In a down cycle that is about to end, we will start to see themes. We will start to see our lists populate with relative strength setups. And then we can start to anticipate, or at least have the potential to start watching for a new upcycle to start. And the number of setups will naturally increase when we're later trading late in a down cycle, because the trend is about to reverse to the upside. So I think, Richard, next is popular market cycle systems. Now we'll basically get into covering some of the popular ones that you guys know, how, what all the concepts that we've talked about so far, how they kind of apply to the popular ones here. So,
Yeah, sure.
Richard, yeah, you
The
can go
first
ahead.
one, the stage analysis system. Again, this is more for the position traders or even the longer term active investors. It's looking at weekly charts, identifying whether you're stage 1, stage 2, stage 3, stage 4. I'm sure many of you are familiar with this system. I think this works extremely well and gives you that nice longer term context. But you're basically using the 30-week MA. Are we above a rising 30-week? That's stage 2. Are we below a declining 30-week? That's stage 4. And then you can apply your smaller, shorter term market cycles within this overall context. So just because you're a swing trader doesn't mean you have to ignore this completely. You can incorporate it if you find it useful for you. And that's kind of how I think of things. I kind of treat this as my longer term system, and then apply the shorter term rules on top of that. But again, I think a key thing is that this system was developed by going back in history, studying the cyclical nature of stocks and their movements. That's going to be a common theme between all of these. They're noticing patterns and building a framework to think about, how do we define an upcycle? How do we define a down cycle? So I think that's good for stage analysis. Here's it applied with our Deep View stage analysis indicator based on our conversation with Stan here in Deep View. We've got a stage 2 back there in late September of 21. We transitioned to a stage 4 pretty quickly in the start of 2022, and then early in 2023 we've started a new stage 2 uptrend, and now we're in currently stage 3. So this is a really good system. I encourage everybody to learn it and study it. Even if you don't trade on a weekly basis, you can apply a lot of these concepts to different periods. Anything to add on stage analysis, Rai, before we move on? Oh, you're muted.
Yeah, so it goes back to the point of when we spoke to Stan, he said, hey, I started, he used to subscribe to people and listen to opinions, etc. Blew up a couple of accounts, and then he said, hey, I'm noticing a pattern among stocks. And he said this 40 plus years ago, right? I'm noticing a pattern. They tend to consolidate. They tend to consolidate into what he eventually labels stage 1. They tend to break out of that stage 1, go into these stage 2s, and then they consolidate once again, go into stage 3s and break into stage 4s. He visualized that pattern, right? That seems to happen with most stocks. Then he basically put labels on it, and he made his own system from it. So that's again, it's basically a cyclical system that's looking for patterns. Essentially, that's what we're looking at the end of the day. So let's go into, I guess,
Yeah,
the next one, Richard.
and take a step back before we move on to
Yeah.
this one specifically. Um, I answered a lot of questions today that are, is this indicator the best one? Is this system the best one? I think the overall point that we're trying to get here is that number one, you need a system, and that system should make sense to you, your style, and your time frame. You can use the cancel and follow through day system, distribution days, all that, if that works for you and makes sense for your time frame. The stage analysis might not work for everybody. So if it doesn't work for you, if it doesn't match your time frame, your goals in the market, if you're a day trader, then don't refer to it. But you need something that gives you situational awareness about, is this a good environment or bad environment for my trading style? That's the overall point here. Um, and a lot of these have share very similar core principles, and that's why we're kind of sharing them. But Can-Slim might be best for this person. Stage analysis might be best for this one. New highs, new lows might be the best indicator for this person's trading style. Go back, study history, look at a few of these different examples, and see what works best for you, for your personal style. Don't take anybody's word for anything, because at the end of the day, it's going to have to work for you. So I think that's really important.
And they
Um,
all work.
yeah, they all work.
That's the most important part.
Yeah,
Even RSI works. I see people say, "Hey, RSI doesn't work." RSI works. It, the guy that invented it worked with him, so that's why we
yeah.
have it today.
And another comment I saw is it was referring to Can-Slim. The person was basically said, all this sounds very complicated, and why not just use the uptrend under pressure, uptrend, downtrend? I mean, you can do that, but you're putting your faith in somebody else. And also, at the end of the day, they're making those calls based on a market system framework. So you're basically just using their framework secondhand, third hand, and it's going to be, you're not going to build that intuition about developing cycles, and you're going to be a few steps behind. Sometimes they do a pretty good job, but sometimes they're a bit late, or a bit earlier with their calls. So if that's what's
No,
going to
no
fit your
success.
style, if that's what's going to fit your style, the time you have allocated to trading and routines, go for it. But building your own style is building your own system, market cycle system, is always going to get you the best results at the end of the day. And Rai, go ahead.
Yeah, I mean, I would say like no successful trader that we know sat there and used someone else's work
Yeah,
for all of their success, right? They took parts, bits and pieces from everybody. So if you look at Minervini's books don't state something drastically new. It's William O'Neill's work, stage analysis, and then his own learnings on the market and how it's changed combined into one, right? At the end of the day, that's what it is. Wyckoff's work influence, we get into that in the historical analysis, but every trader was influenced by someone else in the past, but they put their own spin on it, right? They took the different elements, combined them into what worked for them. And you want to be doing that same thing, right? At the end of the day, you can only subscribe to so many people's, you can only follow so many people. But at the end of the day, if your decision making isn't coming from yourself, you're doing a disservice, and you'll never be more than, you'll never get out of this mediocre approach, which is basically, you'll never be a professional in this space if you can't take all of that, internalize, and make it your own, and maybe put a different spin on it. Like, hey, I'm observing this is happening based on these observations. This gives me most conviction, and then I'm acting on that conviction. If that comes from within, it's way better than if it comes from someone else at the
and
end
it
of the
gives
day.
you confidence, right?
Yeah.
And
Yeah.
confidence is key. So
Yeah.
getting back into the specific one, Can-Slim, a fantastic system, especially if it fits your style. Looks for follow through days. After a rally attempt has been established, there's a rise of 1.5 to 2% on large volume that starts the upcycle. That's a perfectly valid system, and a lot of these, and by the way, a lot of these will line up at very similar points, because they're based on the cyclical nature of the market, and based on systems that are developed from study of the market. So this is a perfectly valid way. I know Ross has said distribution days, don't matter nearly as much as they used to. A lot of people say volume is less reliable. So you have to take that into account and maybe adapt it a little bit to suit your style. But can slim fall through day system, definitely a good way to go. Um, yeah, next. So this is the first system I kind of learned. So this is from Dr. Eric Wish. He has developed his own general market index, GMI, where he scores the market out of a score of 6. If it's above 3 for 2 or more days, he views that as the start of, the GMI signal being green. If it's below 3 for 2 or more days, it's red. He's got 6 criteria that go into this. He's looking at new highs. He's looking at the QQQ and SPY, their short-term trends and longer-term trends, and the trend of the IBD Mutual Fund Index. So this is what he's developed and what works for him based on his experience, many decades in the market. And he's noticed that when this overall metric, this score that he's developed, yields a green signal, that's when his style works, his style of trading works. So this is a very specific example that you can definitely go ahead and study as well. A lot of people look at new
And
highs, new lows. Yeah, go ahead.
it's a really good example of he took bits and pieces from different, things that he learned over time, put them into one and gave it a score. So now he trades, if the score's high and he sees all of these things lined up, he's personally confident in it, right? And he's going out there and trading in a bullish way. Whereas when this goes low, based on his findings on each of these components, right? Then he's not trading, as bullish in the market. So I think this is a really good example. You all of us in here can at some point kind of take bits and pieces that we learn from many different people and maybe build our own, system around that as well. That should be the goal, like the standard. That's what will move you closer to that stage 3. What will not move you closer to stage 3 is, not having something like this at the end of the day. So.
Yeah, I saw a question. Where can I learn more about that? You go to wishingwealthblog.com. That's Dr. Wish's blog. And he's also done many interviews with us and presentations where he talks about this. So definitely recommend looking into it. This is Oliver Kell's market cycle based on his cycle of price action. Also fantastic. I learned a lot from this, and I incorporate a lot of these concepts into my own assessment of the market. And he's done a lot of interviews with us, and you can also the entire first webinar, I don't know, was it 2 hours, 3 hours, 4 hours, whatever it was,
4 hours.
was dedicated to the cycle of price action in the swing trading masterclass. Highly recommend that. I learned so much from that and helping put that together. So another very valid framework here. Ryan, anything to say on Oliver's system before we move on?
It's very similar to stage analysis, right? And these things that he spoke, he's using different MAs because his system is more swing trading,
And on a
right?
daily time frame, stage analysis.
And it's
Yeah.
on a daily time frame, whereas Stan Weinstein is a weekly with a 30-week MA. So he adopted what he saw on the daily, made a cycle out of it, and there's no other expert. He's the subject matter expert on his own system. You should be a subject matter expert on your market cycle system at the end of the day, right? That's what we want to achieve. That's what makes him an investing champion, right? And that's where all of us that are here 300 plus want to get to one day. So he internalized what he learned and came up with this the system that works for him at the end of the day. So
Yeah, and Kip said Oliver's trading cycles within the Weinstein cycles. Yeah, the longer term view
yeah.
is Weinstein, and then yeah, he's looking at multiple time frames. Exactly, perfect. Another example of a great system is the recent masterclass we did with John Boyk. He has incorporated a lot of new highs, new lows to tell him about the breadth of the market, the health of the market. We went through market cycles from over 100 years. I think it was 120 years of market cycles, looking at what were the new highs, new lows reading. How did that build intuition into the top traders, Livermore, Darvis, all these guys looked at this similar metric, and we also apply it to the present as well. So the new highs, new lows, I saw a question about that. Is that a good indicator to incorporate? It definitely can be. Go ahead and study it. Look at how this metric is acted during different market bottoms, market tops, all of that, and you'll start to build a system framework around that. But definitely a really interesting indicator that can tell you a lot about the health of the market. And we talked about that extensively in the historical analysis masterclass. Right, anything you learned in particular about this going through that?
No, I mean, it correlates very well with anticipated downtrends, or especially when you're definitively in a downtrend, right? It makes it clear as day. So, November 21, as the market headed into 2022, and we all remember 2022 really well, there were signs. There were very clear signs as to what is about to happen. And again, John's mastered this because he has a lot of history based on this, you know, uh, net new high lows alone. And he keeps track of it in a calendar format. What is this? It's the same table that I showed you guys earlier, but it's for his market cycle system. He's
Right.
keeping track of these numbers, and he says, when these are positive, I'm bullish. When these are negative, I should be cautious. Simple. It's a very simple system, right? So
Yep, perfect. All right, so I think we'll pause there now for any questions you guys have, but then we'll get into the last segment, which is building a market cycle system, the 7 different steps. And let's see if there's any questions coming in here. Let's see. Yeah, let us know if you have any questions here. I think we're good to keep moving. So let's get into this last bit. How do you build a market cycle system based on everything we've kind of talked about? So I kind of put together a kind of step-by-step framework that you can use. We'll go through each of these 7 key steps and go through an example of building a market cycle system using the 21 EMA. So this should be a lot of fun. So here are the 7 key steps that we'll go through. Number 1, choose your time frame. Is this going to be for position trading, swing trading, long-term investing? The market cycle system you develop is going to be vastly different depending on that time frame, and you want to apply it to your own personal one. Then choose the relevant indicators slash tools. We talked about a lot of different ones today. We're going to just use the EMA today, but we've got a list there for you of great ones to think of and potentially incorporate. Step 3 is just to start simple and build an initial hypothesis rule set around the indicators that you choose to use. And then step 4 is to go ahead, study history, look at how these indicators acted in real life at market tops, market bottoms, short-term bottoms, short-term tops, all of that. And then step 5 is to take that historical study and condense it into observations surrounding those indicators at those key moments. Step 6 is to incorporate those observations into more concrete market cycle rules that define uptrends, downtrends, as we've talked about today. And then step 7 is just iterate. Keep doing this. Make small tweaks that help improve it with every new market cycle that you experience. So that's pretty much the 7 key steps. And then just a really big reminder: keep it simple, especially to start with, especially if you're stage 1, early stage 2. You don't want to get bogged down with 10, 20 different. It's like analyzing a chart. You want to keep it as simple as possible so you can actually see what's actually going on. If you're looking back at a market crash and you're trying to look at 10 different market indicators at the same time, there's going to be so many conflicting signals going on that you won't know exactly how to process it. Keep it simple, 1, 2 to start with, and go from there. If in the future you study more indicators and you can build rules about that and it's not too conflicting, it still makes sense, you can add that layer later. But I think it's really important to keep it simple. Rai, anything to touch on with the overall framework here?
no, I think, yeah. And this goes, you iterate over, get better, keep it simple. Don't look at too many. I think you hit all those points. So
Cool. So let's dive in. We're going to choose kind of a more swing trading time frame, operating kind of from base to base here. So we're going to build a swing trading cycle system, and we're looking to kind of capture those trends, capture those momentum moves from different consolidations. So that's step 1 taken care of. Yep. Moving moving on, choose relevant indicators. We're gonna keep it really simple here, and this is a great suggestion to just start with for you guys. We're gonna use the 21 EMA and apply it to the QQQ ETF, the Nasdaq 100 ETF. Again, just keep it super simple. Just use two tools, and I think this is a really good spot to start with, and it's pretty darn effective if you chart it historically. So step two taken care of. We're going to choose relevant indicators, but I think I've got a list of good ones on the next slide that you guys can use. So yeah, so here's just some ideas. I saw some others listed in the chat, like the McClellan oscillator, the T2108 and T2000. You can use moving averages, new highs, new lows, stocks above MA. We've got some of those built into Deep View. The number of setups you see, number of screen results, those can be more qualitative. Quality of setups, another qualitative one. Stock gauges, key stocks like leadership. How is Tesla performing? That can be incorporated into your system. Name, advanced decline line, market structure on indexes, the Fed, COT report. All these can work. It's about finding the ones that work for you and what makes sense to your style and what keeps it simple. Don't start out with using every single one of these. Use one, study it, see if it works for you. If it doesn't, try another one. But always try to keep it simple and think about what actually matters for my trading style, what actually defines a period where I want to be aggressive in the markets, a period I want to be defensive in the markets. Take a step back and think hard about that, plan everything out before you just dive in and try to use all of these. All right. So step three, start simple, build a basic rule set. We're just going to say an uptrend is above a rising 21 EMA, below a declining 21 EMA is a downtrend. That's about as simple as you can get. And we gave a very similar example to this early on. So next up, step four, study history. So we've got a bunch of slides here. I'm actually going to request remote control so I can click through here. But this is looking back at the 2022 top. You can see, there we go. We've got an upcycle here during this period, consolidation, chopping around the moving average, no clear trend here. And then we clearly switch into a downtrend going back here. So you basically want to bring up a lot of different tops and bottoms, intermediate tops and bottoms in history, and look at how your indicators are acting during that time. Take notes of, there's a lot of retests, there's a lot of choppiness. Whatever relevant observations you make while you're doing this study, make sure you write them down so you can incorporate them later into your rule set. But you can see we've got the uptrend, so this would be an upcycle here, just chop, not much going on, then a clear down cycle with a few kind of 1-2 day pops above the moving average, but still overall declining. Next up, I believe this is, this is 2023, early 2023. We had those rallies above the moving average. This would be an upcycle. This would be a down cycle. Again, we see pops above and below. We see a choppy uptrend period going up and down, all of that. And then we start to see, again, a sustained upcycle move based on our very simple definitions. So, noting some trends, we can get a lot of false breaks here, a few days above and below. So that's something to take a note of. And we also get pops above it, in the context of an overall downtrend. Rai, are you trying to move your mouse?
Yeah,
there you go. Then we've got the 2020 market correction and bottom here. We see a nice sustained move above that. So it worked really well in this case, protected you from the vast majority of this decline, got you back in pretty nicely here. Then we've got the later correction that year where we lose a lot before we meet that line. So you could take a note that, hey, this indicator is a little bit delayed. Maybe I should think of a circuit breaker rule where, if it's dropping really hard, we're still above it, maybe no new buys at that point. So just keep taking note of these observations. Where would your market cycle rules help you? Where's maybe some room for improvement, both to the upside and downside? And you can see a short-term trend, we fail, and then we start to get above it. We have a really strong move off the bottom here, and it kind of triggers late, just like this triggered late to the downside. So again, that's something to take a note of and basically think about how can you adapt your rules to take that occurrence into consideration. Here we've got the 2009 bottom. It protected us during this downtrend. Again, a lot of chop. This is going to happen in any system. So plan ahead for that, and practice progressive exposure and manage risk tightly as always. Then we pop above it, and this is what really starts a sustained move upwards, and it captures it nicely there. So again, we're just going back, studying key bear markets, key corrections, key uptrends, key downtrends, and taking note of how our market indicator does in this case. This is 2010, the flash crash here. You can see actually, we were already below a declining 21 EMA before that occurred. It caught this uptrend nicely and then got us out. Before that, there was a lot of chop though, some false signals. And then when we finally got above it, we had a nice trend. So one thing to think about when you're looking back historically is, does your indicator, are choppy periods shorter than the longer term trends that it captures? That's something to take note of. And you want to be able to capture those long periods, because those are going to pay for a lot of those choppy signals. It's very similar to trading. We want to ride the winning periods as long as we can. Here's another, this was 2015. Again, it got us out before the large decline, so it worked pretty well in this case. But over here, long choppy period, this can really chop you up. So maybe you incorporate some rules about, if you're getting chopped up a lot, you position size less to try to protect yourself. Just think about ways your market cycle rules can be improved, observations you make as you study these historical periods, because I can promise you there's going to be a choppy period like this at some point. It's not always going to be clear uptrends, clear downtrends, and you have to plan for that accordingly. So yeah, so that brings us to step 5. After you've gone back, looked at history with whatever indicator it is, new highs, new lows, 21 EMA, whatever it is, write down your observations. And here are a few that I kind of noted doing this exercise. The 21 EMA captures powerful trends really well. It keeps you in those momentum moves. But during choppy periods, there can be a lot of false signals. Also, it can be activated kind of prematurely during downtrends with straight off the bottom moves. So, very sharp kind of short covering rally type moves up into moving averages. It pops above for a few days, then just fails. So that's something to maybe think about how we can improve that. And in general, though, the 21 EMA cap protects us really well during this market decline. So those are just kind of 4 notes that then we can incorporate into actually building our set of rules. So here's kind of a starter set based on this exercise. An uptrend to kind of protect against the false signals. It can be 2 closes above the 21 EMA. The downtrend, 2 closes below the 21 EMA. You could add qualifiers. Hey, the 21 EMA has to be increasing. Hey, the 10-day has to be increasing. But again, we're keeping it simple with this first rule set. Then we've got some uptrend rules. First few days of market cycles start with 1/2 positions. With progress, scale up quickly. Then in a downtrend, no new buys, consider selling partials in weakest positions, and then treat strong individual positions on their own merit. So yeah, that kind of puts it together. And then the last step is just iterate. With each new market cycle, do post-analysis. What did your market system do well? What can you improve? How can you simplify things? I really want to stress this point. Simplification to me is better than adding more and more layers just to try to fit every possible situation that you can have. There's this concept thinking in especially machine learning and modeling called overfitting, where you try to account for every single factor, and that makes your overall system less robust and less effective. So simplification usually leads to more robust framework system. So definitely think about that as you're doing that. So yeah, that's pretty much the 7 steps. Hopefully bringing it all together and actually bringing it to life helped cement things for you. Rai, anything that you'd add about these 7 steps and the example that we went through?
No, I think the last one likely the most important, right? In terms of you see what works, you see what doesn't, simplify. Don't have too many. I did the same thing. I had 4 to 5 different inputs in addition to my trend identification of uptrend or downtrend. And it would say, hey, put calls doing this, my volatility indicators doing that, net new high lows are doing this, McClellan oscillators doing that. Now you're in a state of confusion because you don't know what to do. Half of them say, nope, it's not a good thing. Half of them say, yeah, you got to go buy it. You don't want to be in that spot, right? That's where simplification, I think, comes into play quite a bit. Is don't be in that spot where even the journaling, you want to have very precise data points that you think will help your decision making and give you clarity on what the trend is, right? And too much journaling and jotting down everything that's happening isn't going to help you because it will just put you into more of a state of confusion, right? Um, so yeah, start simple and then iterate, add bits and pieces, but subtraction by addition type of thing, right? Not just addition. I see some people just look at the whole, kitchen sink, and then at the end of it, like you just don't understand what they're doing, or it's too complicated, right? Or they've made it too complicated for themselves. John Boyk uses net new high lows. He trades based on that. There's nothing else he's doing. He's just looking at that plus tracking leaders.
And
Very
yeah,
simple system. Stan Weinstein is looking at stages, and that's all he looks at. His whole system is based on how many stocks are in stage two. If stocks in stage two are higher than stocks in stage four, hey, it's a good probability that we're in an uptrend. Very simple system. Um, the canceling system, so the follow through day. So once a follow through day happens, then traders that follow that system go and establish long positions, right? That's again, they're doing that again and again. They look for a very specific definition of when this happens, the trend is about to change. Again, a very simple, I would say, a very simple system at the end of the day. So whatever you build for yourself, MA based, sentiment based, breadth based, whatever time frame you pick, think of these people that have built, one chart that comes to mind is if you go to Minervini's feed, he pointed out all the setups that happened as the market turned around from 2022 to 2023. His trend identification system is based on number of setups and pivots that he sees are about to, acting well and are buyable. When that number is high, it's likely that the trend of the market will reverse. So he functions that way. So have something that gives you a good gauge on what you think is best, right, for yourself. So we have all of these examples at the end of the day, but the best one is when you will incorporate some of those into your system, but keep it so that you're not in a state of confusion. I've been through that. Richard, I'm sure you've been through that. Ross, everybody goes through where you go crazy to one spectrum, having too much info to work with, and then you scale back, so that you make it easier on yourself to make a decision.
yeah, and going back, can you go back to step 6 real quick?
Yep.
Um, there's a question, what does my system look like? What does Rai's system look like? Mine is pretty darn similar to this on the QQQ and the IWO. Those are kind of my two inputs. And then I also incorporate some of Oliver Kell's his cycle of price action, where we are in that cycle, extensions for moving average, a little bit like that. But at its core, this is pretty much my system. And Rai, I know you've developed your own with your pivot system, where you can keep it really simple, just above or below that key
Yeah.
pivot.
So
Yeah.
I went through a couple of iterate. Like I used to do McClellan oscillator, put call ratio, the NAIIM numbers, um, and volatility indicators. I used to have 4 things that would tell me what's going on in the markets. It got too complicated as my account size grew. It would put me in a state of confusion. So I got rid of the 3, built, kind of based on that, kind of very similar to Dr. Wishes. It takes a couple of components that I know work, and it gives me like a score type of thing where which I converted it into pivots, but it, it makes it simple for me to make a binary decision. Hey, we're above this price, I have to be bullish. We're below this price, I can't be bullish. I have to scale back, be conservative, lower my position size. All of these things that Richard's talking about, right? These things. So these apply to any system, but the trend identification component is usually what's different for different traders at the end of the day. So
Yeah, and I think I've seen my favorite comment slash question here today from Alberto. I'm going to study the McClellan oscillator and see how that can help me. Keep it as simple as that. Thanks for the direction, advice, and inspiration. That's awesome. Yeah, whatever you choose, study it. Go back.
see it through. I think a
Yeah,
lot of people use it for a week, maybe 2 weeks, and then they want something new because that 1, 2 weeks, that thing was confusing. Like net new high lows is used by John Boyk. He went 100 years. He just went crazy with it. Like he went back and he has calendars of years upon years. Now he has so much evidence that he just knows how to do it. So yeah.
yeah.
Same
Study
thing
it,
with
learn it,
study.
build
Yeah.
intuition about it. Yeah. So I think we can move on here now. I think that's pretty much the last section. We've got some key summary here. So market cycles are a technical representation and incorporation of human psychology into the
Based on your
markets
time frame.
based on your
Based
time
on
frame.
your time. Yeah.
Yep. Um, cycle phases determine the effectiveness of different strategies. I think this is something everybody learns. Buying breakouts doesn't work 100% of the time, especially if we're in a bear market, a longer term down cycle. You have to be aware of that, build situational awareness around that. And finally, and most importantly, you need a system for determining these phases. So everybody here who answered no at the very beginning today when we asked, do you have a market cycle system? I want you to put in the chat now what you're going to study, or just if you say yes, that you're going to go ahead and study and build yourself a system, because that will be what brings you to the next level and helps you progress from stage 1 to stage 2 to stage 3 eventually. So perfect. I see some yeses coming through in the chat. So perfect. Um, so any other key takeaways that everybody should think about, Rai, from today's webinar?
No, I think most important is just having a very simple count, market cycle count system. It will help a lot of stage ones go to stage two, and a lot of stage twos figure it out, right? Because then your decision making is going to improve. Again, it's not going to be perfect. You want to focus. What you will do is you'll put a system in place. You'll have the choppy phase will be the most frustrating for traders. I still have where I get false signals and I'm supposed to be bullish, but I can't find anything, so I stay back. But then setups arise later on in the cycle. Everybody goes through it, but just having that, for our audience, I think it's much more important to just have a system, right? Make sure you have it. Without it, you can't really find sanity in your, decision making or repetitiveness in your decision making. So.
Yeah, and just for swing traders, I think the 21 day or 21 EMA is a good place to start. For position traders, maybe the 50 SMA, 65 EMA. You can start studying that and incorporating the different layers to it. But yeah, I think that's pretty much it. I think let's run through the rest of the slides here. Um, for everybody watching, the replay, definitely go ahead and download the Ultimate Trading Guide. The link will be in the description as well as popping up right now. A really valuable resource that we spent months on and really put the time in to build a written system with that goes through all that the webinars go through in depth with a lot of examples, setups, edges, all of that. Definitely go ahead and check this out. It's completely free. Just click the link and you'll be brought to it. And moving on, the recommended tool is, of course, DeepView. We'll be incorporating a lot of what we talked about today into the system, where you'll be able to use that in DeepView coming pretty soon. So definitely check that out. And in my opinion, it's the best tool out there for growth style traders, swing traders, or position traders. A lot of customizability, flexibility. The screener is top notch, and you can really dive deep and speed up all your different processes and routines. So definitely check that out. And let's move on. I think just one last slide. We've answered a lot of questions today, but we'll see if there's a few more here. Rai, anything that you really want to emphasize about the Ultimate Trading Guide, DeepView, or anything like that?
No, I think
DFU turns one today. We should mention that.
yeah, DPU turns one today. It was, today was basically the first day we gave access to real clients on the DPU side. So that's exciting. The platform is much more performant, stable. We've added a whole bunch over the last year, and we're just about to get started with that. With the Ultimate Trading Guide, make sure you guys, pass it on to other people, spread word. We've had amazing response on YouTube and all of these other places. We'll improve this guide, we'll make it better as well. And as we do these webinars and we see your questions, we will make these webinars even better in the future as well. So that will be, again, a process that will continuously improve over a span of time. So I just want everybody to, if you found it beneficial, you like what you saw, any additional questions, feel free to tag Richard and I on Twitter, or on YouTube. If you're watching this after the fact, you can always put that in the comments, and we'll get to it and answer those questions as well. So I see a few questions. Black Friday deal for DPU. This is the deal for DPU. 49 a month, 490 a year. Will be the lowest possible introductory price. So we've had a sale for the past couple of months already, so it's ongoing. Where's the link to the Ultimate Trading Guide, Richard? If you want to paste that.
Yeah, I'll get that real quick. Yeah, and do you want to touch on a little bit about how far DFU has come and kind of our goals with that going forward?
Yeah, so later on this year, we'll have iOS and Android apps. We will also have a flexible dashboard, which I think will separate the product a lot more from what exists in the market. So it will combine that TC2000 feel with the TradingView feel with the MarketSmith feel. So it will really bring DPU in its own category in a way. Early next year, we will have our custom formula builder, which will basically allow you to build any data point that you want for yourself. And then journaling, right? We will bring journaling into DPU, and that will be included as part of the subscription as well. The only thing is, as we add more and more, it will get harder and harder to maintain the same pricing. So that's why I encourage a lot of people to be early adopters, lock in their price, so that we could we continuously reinvest, continue to build a platform, but at some point it will be very hard to keep the pricing the same. That's just the economies of scale type of stuff. So
yeah. And I see a question from Randy. Are there video tutorials on DFU? Yes, 100%. That's my job. I've posted a lot on the YouTube channel for DFU. We'll put a link down below. But also embedded in the knowledge base, which is included in DFU. We've got plenty of video tutorials walking through every single feature of the platform. And every single week I host a live basically tutorial where I take questions from members. And I see Joan in here. She's been attending a lot of them, where I walk through how to build a screen, how to manage your watch list, how to use the different features, data panel, data columns, all of that. So yeah, we've got tons of resources built in to help speed up your learning processes. So I think that's enough on that. Rai, any key closing messages that you want to leave everybody with today?
No, I think I hope you guys learned a lot on the market cycle stuff. Not a lot of people seem to talk about it. They seem to have like a mental frame of what they're doing, but I think it's important, especially for stage 1-2 traders, to have a very definitive way of making sure that you're on the right side of the market. Downward trending equity curve, stage 1 and 2s, is basically you're on the wrong side of the market at the wrong time, and market cycle, the market cycle framework just fixes that, right? Or is an attempt to fix that or curb those losses at the end of the day. So I think with that we could end it, and I hope you guys have a good weekend.
Yeah, have a great rest of your Saturday, everybody. And thanks so much for tuning in, everybody watching the replay. Leave a like down below, subscribe if you're new to the channel, and we'll see you guys in the next one. Take care.